Good afternoon, everyone. We're going to get started. My name is Erica Swift. I'm a member of BioStrategy Partners, and I will be your host today. Welcome to the Practical Knowledge Series, where our topic is raising capital in the current market conditions. For those unfamiliar with BioStrategy Partners, we are a nonprofit consortium of academic medical centers and research institutes that provide programs and services to advance the development and transfer of academic research into the marketplace. I would also like to recognize our sponsors, Stradley Rowan, CBRE, MVM Associates, Silverstein Properties, Cantor Fitzgerald, and UPA Associates. Without them, this program would not be possible, so we send a thank you to all of our sponsors. Lastly, a couple of housekeeping items. Please silence your mic through the session, and if you have a question for our panelists, you can enter that question in the chat. We do encourage audience involvement, so enter as many questions as you may have during the panel discussion. So now at this time, I would like to turn the discussion over to today's moderator, Dr. Bryan Tsao. Bryan?
Thanks, Erica. I'd like to thank everybody for joining us today. My name is Bryan Tsao. I'm the Program Director of BioStrategy Partners. And like many of you, I also wear different hats. I also hold a position at the Chamber of Commerce for Greater Philadelphia as the Manager of Life Science and Healthcare Initiatives. Happy to connect over that if you're interested to talk about that. But today, I'm going to be moderating this panel on how to raise capital dilutive capital investments, especially in the current market conditions. But before we start, I'd like to ask the audience, if possible, put your title and your organization in the chat, and so that the panelists can know who their audience is, so that they can tailor their discussion a bit towards you. And all right, so I guess we will go ahead with the panelist introductions. I'd like to introduce Rick Jones, and I just want to have the panelists introduce themselves. Go ahead, Rick.
Sure. Can you hear me? All
yes.
Right? Okay. So hi, everyone. Again, it's Rick Jones. I'm one of the investment professionals at BioAdvance. BioAdvance is a locally based early stage biotech investor. We're actually a nonprofit evergreen fund, originally set up by the state, but now operating independently. And we have a mission to improve the local biotech ecosystem here in the greater Philadelphia region. We typically invest at seed Series A stage for therapeutics up to $1.5 million in a first commitment. And we also have a program to put small amounts, say 50 to 200,000, into companies that need to accomplish a milestone or two before they're ready to raise an institutional round.
All right, thanks for that, Rick. Let's go on to Mike Sermonaro. Go ahead.
Hi, I'm Mike Sermonaro. I'm the president and COO of Thrombolex. Thrombolex is a commercial stage medical device company that I helped co-found in 2016. Prior to co-founding Thrombolex, I served as the co-founder of BlackRock Private Equity Partners, a $5 billion private equity investment fund manager. We invested across the spectrum of venture and private equity. And prior to that, I was a co-founding member of the private equity and venture advisory platform at Bank of America.
Okay, great. How about next, Anurag?
Hi, everyone. I'm Anurag Agarwal. I'm a principal at a venture fund, OC University Partner, which is a local venture fund that invests exclusively in university spin-outs. I am one of the investment professionals on the life science team, which looks at all life science and investment opportunities, and our focus primarily is on therapeutics.
All right, thank you for that. And as you can see, we have a very experienced and very smart panel that can answer all your questions on how to raise funding. So if you have questions, please put them in the chat. I will be happy to incorporate them into the panel discussion. So To start off, I'd like to define a couple terms. So we're going to be talking about dilutive funding today as opposed to non-dilutive, which is any capital a business owner receives that does not require them to give up equity or ownership. Dilutive funding is the opposite, where a capital a business owner receives has to cede a portion of his or her ownership in order to receive the funds. So there are a couple major venture dilutive funding types, and these are venture capital and angel investments. Rick, could you kind of describe what the difference is between those two briefly?
Sure, I can take a stab at that. So, generally speaking, venture capital is money that's invested by a professional group of investors. And this professional group has raised the money that they're investing from institutions and wealthy individuals who need to find a place for their money to generate income. So they commit a certain amount of money to the venture capital group. The venture capital group cobbles together all these commitments, and and at the end of the day, they have 100 million or 200 million or 600 million dollars in a pool to invest. And then when they are finished, when they get some sort of realization on one of their investments, they are returning um, that money back to their limited partners, the people who made the commitments to them in the first place, while they retain a certain amount as their own profit. Angel investors are, generally speaking, individuals who invest from their own individual accounts directly into companies. Um, Obviously, they're usually wealthy individuals with plenty of money to invest above and beyond just buying relatively safer bonds or stocks in the market. They're willing to take these high risk investments. Sometimes these angel investors band together in groups so that they can cooperate in doing diligence on deals and so on. But typically speaking, even if their group decides to invest, they're each writing individual checks. So you end up having, instead of one venture capital firm as the owner of your stock, you might have 15 or 20 angel investors owning that amount of stock, and to which you have to communicate and get votes and so on. So those are some of the major differences between the two.
Okay, thank you for that definition. So part of what we do at BioStrategy Partners is to, again, talk to the investors and the academia labs, as well as biotech companies, to find out how we can help them receive funding for early stage technologies. And a lot of the conversations around what the market looks like currently is that it's going downhill, but I don't necessarily understand what that means. So, Mike, could you give a perspective from the biotech side on what the market looks like and where it's headed?
Thank you, Bryan. Biotech is really sort of following the rest of the venture market in terms of seeing a little bit of a downturn in terms of funding this year compared to last year, which was an absolute record year for venture funding, not just for biotech, but for the global venture market. And we're really seeing volumes off by about 30+% this year. Sounds like a lot, but when you really think about the fact that last year was a little bit of an anomalous year and a record year, if you kind of take 2021 out, and if you look at the pace of investment this year, it's really on track to exceed what we saw in 2020 alone, which was at the time viewed as a very strong year for biotech investment. We're also seeing some very large deals getting done this year. There were 46 biotechs that raised over $100 million or more, and that's with a median size that's typically around 17 million in this space. So we're seeing some interesting activity. Where we've seen a major change this year has been the fall off in exits, particularly IPO exits. I think we saw something like 9 venture-backed biotech IPO exits so far this year. Maybe there was another 5 biotechs that were not venture backed that also went off. But those numbers are compared to 111 biotechs that went public last year and another 91 that went public in 2020. So, and obviously a lot of that is tied to what we're seeing today in the valuations in the public markets and what's happening with the equity capital markets.
Okay, thank you. So what about from the investor side, Anurag? What are you seeing in terms of the market? Are you seeing the same as Mike, or yeah, what are you seeing?
Yeah, thanks, Brian. And I think Mike highlighted the two pieces of the world that you see. One is a later stage crossover public facing funds. They have the demand has kind of shrunk there or almost disappeared. And everybody is, the retail investors, they have kind of flown out of biotech. So you don't see that market pressure happening. While on the venture side, the early stage ventures for particularly, they have raised a lot of funds, and therefore there is a lot of capital being deployed, and that's why the Series A's we're talking about are getting done. Now the question is, those were done much earlier and they're being announced now, versus what is going to look like in 6 months to a year, given the pressures on the public market will slowly move into the private side. It's just the private side a little bit more resilient. So I think for that's how I think that right now the world is kind of two different worlds. The early stage seems to have capital, a lot of support. The late stage is seeing the pressure, and any company in transition is seeing some pressure as they're moving from early to late. But going forward, because of that late pressure in the late stage, the early stage things may slow down going forward.
Okay, great. So you've mentioned how the early and late stage companies were affected, but what about the types of the companies that are being invested in? Are there any changes in like medtech versus therapeutic or digital health? And Rick, I'll pass this over to you. Are you seeing anything in particular?
Well, there's a couple of changes. I would just say, in general, medtech and diagnostics in particular have been, over the years, less well funded than therapeutics and more recently digital health. And so they start off from a somewhat compromised position as it is, with less investors who are interested in those areas, generally speaking, smaller rounds and so on. So yes, they would be particularly impacted by any general slowdown in funding. I would say one of the other things that I've seen is that in the past, until very recently, it was common to have for there to be very large rounds that were intended not just to advance a lead product and get to certain valuation milestones, but to support a platform and potentially advance multiple products in that platform. And I think people are concentrating more these days on a more efficient way to create value, and that might mean the rounds that are raised are somewhat smaller because they're not intended to support a really wide development of a platform. They'd be more intended to move a high value first product forward to some milestone. So that would be in some. I think we'll see not the complete disappearance, but the overall size of these rounds. There probably won't be quite as many in the sort of $50 to $100 million kind of Series A range, and more rounds that are smaller and more focused.
Okay. And Mike, are you also seeing that as well? Are you, when you're lining up investments to apply for, are you going after more smaller investors, or are you going after the big series investors?
Well, we're a little bit of a different animal at Thrombolex in that we've brought in a group of industry partners who have really helped fund our business along with management. But in terms of the general market, Brian, I think the other two panelists really hit the nail on the head. And we're really seeing late stage and technology growth being the most negatively impacted from the pullback this year. And I think Rick was right on in terms of his commentary of the market. The last month, I think we saw venture investing globally was around 22.3 billion for late and growth stage sectors. It's down like 38% so far this year from where we were in 2021. Some of the change that I think we're seeing is really in this whole area of segments of the market that were most positively impacted going into the pandemic, right? We've seen all of this stuff with digital change, at-home work companies, healthcare companies, education, finance, shopping, and entertainment, everything that's been driven towards e-commerce and online type of investment. And now there's some concern in the market that we're seeing around, is that going to continue? Or as people start going back to school or start going back to work, are we going to see a slowdown as it relates to all of that? But I think there's been such a dramatic shift in tech infrastructure, cloud computing, cloud service companies, that I think we're just going to see this ongoing growth in that space. And I think longer term, it's going to be very interesting to see where that all shakes out. I mean, last year was a real milestone year for the whole industry in general, but cloud mobile computing has been investing for over a decade. We're just now going to start seeing some really meaningful and interesting companies come out of that. And it's creating an order of magnitude improvement in network speed that we just haven't seen before, with 5G coming down the road and some other major technology changes. So it's going to be an interesting space to watch over the next couple of years. And as we get through not just the pandemic, but this current downturn in the public markets, and whether or not we head into a mild or severe recession, what happens next is going to be really interesting in this space.
Okay, great. So what about in the venture capital perspective, Anurag? What are you predicting would happen in the next couple of years?
I think again, for the early stage investors, I'm sorry, is it my side that is creating some back? Or is somebody else on?
You're good. All right.
Okay. Yeah. So I think on the early side, there is going to be a change in a way that people would have to support their own portfolio a little bit, as because these companies which were able to raise money from, let's say, crossover funds or on the public markets would still need the money to continue. So the early stage investors will have to reserve their capital a little bit for supporting those companies when the external capital has dried up. And that is gonna mean that maybe lesser new companies are formed, or they are formed with less capital, so that the key focus going forward for the companies will become is, how are you being capital efficient? That was not a question that we usually asked in the last 2 years. The products become more in focus. So I think that's the venture funding. There is a lot of money available, but now it's going to become a little bit more difficult to fight for it, because it has to be spread across stages now. Because even the later stage, because of the public markets being so suppressed, they're going to focus on public market opportunities rather than private market. So I think that's what. But however, if this, with the broader market being under recession, then that's going to impact biotech equally as the rest of the market. So.
Okay, thank you. And all right, I think the panelists covered pretty comprehensively the market outlook for the immediate term. But let's move on to some advices on how to raise capital, specifically dilutive funding. So one of the most important things that I believe in lining up deal investments is the time frame around searching for the deals and making sure everything's in order. So Mike, I'm tossing this over to you. What does the time frame look like for deal searches and lining up and securing the funding look like for you? Oh, Mike, I think you're unmuted.
There we go. Sorry about that. I think it's a little bit more complex question, and it really depends on the stage of funding that you're looking at. And we kind of heard a little bit of this from Rick a little while ago. The industry that you're in, as well as the quality of the management team that's at the business. I think a lot of VC firms today are looking for management teams that have experience leading startups and that have successful track records in leading startups. And so that becomes, I think, a key differentiator in our world. But in general, I think the rule of thumb is that you need to be able to run for at least 6 months to raise a typical round of venture capital funding, meaning you probably need some capital from some other source during that time period. We've seen shorter capital raises for more experienced teams, maybe as quick as 3 to 4 months, and we've seen significantly longer time periods as far as 9 months to over a year in other cases. And I think the key is you need to do as much homework yourself on the type of VC firms that you're raising capital from to make sure that they're aligned with you in terms of the stage of funding that you're looking for. They have an industry focus in your particular space, that they don't have conflicts of interest with other companies in their current portfolio. But it's a little bit all over the board, and I don't think there's a single answer to that particular question.
Okay. Rick and Anurag, do you guys have anything to add to that?
I would second the notion that you need to have at least 6 months. I'd actually say that you should plan on more like 9 months these days, and even longer. Unless, the one way you might find that you've shortcutted is to have your eggs all arranged in the basket already. You have the team, you have the pitch, the science, everything is flawless, and you can go out and you take a lot of the burden of the diligence and concern away from the investor right from the get-go. Most people aren't in that position. They're sort of starting a conversation that's going to take a while for the investor to figure out whether they believe the science, whether they believe the team, whether they agree on the plan that's been proposed and the budget that's been proposed. And then there's a whole period in which you have to actually negotiate then the financial terms. So, and it takes a while to find investors, and unless you've done a lot of upfront homework. So the really fast rounds will be those people who've already been out sort of preparing the marketplace by meeting people even in advance of actually opening up fundraising, so that when they do go out fundraising, people already know them, they know something about the science, they know something about the team, and now it's just a matter of saying, okay, we're ready now, can we move forward? The other dynamic that we've already sort of touched on it in the discussion is that given the current marketplace, the other thing that you're dealing with is it used to be that investors you talk to, they had their pool of money, they had some idea of how they wanted to deploy that pool of money. X amount was going to go to new investments in startups, and they'd reserve Y amount for follow-ons. Now they're looking at that balance, and a lot of them are saying, oh, that Y number, that follow-on number, has to be a lot bigger. And so what does that leave? What does that mean in terms of the X number, the amount we can put into new investments? And we're seeing sort of investors make those who are like engaging in those discussions even as they're negotiating with companies about a potential investment. So you really, this is a market where you really can't count your chickens before they're hatched, so to speak. That you have to keep pushing to get the deal done because of the turmoil that exists in terms of people's allocations.
Okay, thank you. So one of the things that both you and Mike mentioned was getting to know the investors. So Anurag, I'll ask you this question. How and where do I connect with investors, and what are some resources that you know that would allow us to meet investors?
Yeah, and that's a very good question. So I think for the, there is a world before the pandemic was, and there's a world today. And so the realities of it has definitely changed. So uh, one of the best ways to connect with the investors would always be through a warm introduction, through somebody in your network. That is the ideal way, and obviously the cold contact can work. We can talk a little bit more about that. And for that, the key thing is to be networking, because you never know what is the connection. Investors are always looking for new opportunities, so it's not like they are always looking for those introductions from their network to find the right opportunities. And VCs rely on their network, and so as more you can get your network to overlap with them, I think that's the best path forward. Now, not everybody has that, and events like these, conferences, presenting, nowadays social media, all of these things can make a lot, have that introduction that can make an impact. And sometimes, as I think it's like fundraising, a lot of it is patience. It takes a long time.
Okay. What about you, Mike, from the biotech side? How do you meet investors? Mike, you need to unmute.
I think it all boils down to networking, as was mentioned a moment ago. You really need to meet with a number of folks, but you also need to do your own due diligence, and you need to be efficient in the approach that you're taking. So you've got to do the homework. You got to know, are the folks that you're targeting or talking to focused on the stage of funding that you're looking for? Are they focused on the industry that you're currently in? What's their view of your particular type of science or your particular type of product category? And the other piece is, what's the track record of that firm, and how well have they done? And if you're lucky enough to get an investment or term sheet from a VC firm, the next is, what can you do in terms of diligence to make the right decision that that's the right firm to work with? And it's not unheard of to ask for, reference checks and talk to founders of prior portfolio companies. And if you can, even get in touch with ones that were failed portfolio companies. And, I think what we miss a lot of times as entrepreneurs in this space is, this is a really risky part of the investment community. With 90% of every startup in the US fails. If you're one of the best venture firms on the planet out in Silicon Valley, you're losing money on almost 50% of your investments. I mean, it's a little bit like baseball. You're Babe Ruth if you're batting 500 out there. So it's not an area that doesn't come with a tremendous amount of risk. But I think the other piece that we didn't touch on that is also important for entrepreneurs is, what are you willing to do from a dilution perspective? We're in the med tech space, and I think it was Rick who mentioned it earlier about how has not been very robust funding in that space historically, and I think that's right. And what comes from that is, when we talk to venture firms about our business, the typical venture firm looking at something in the medtech space would want to put in 25 or 30% of the company. But then they want another deep pocketed investor, meaning another venture firm, to come in. And that firm's going to want something in the range of 15 to 20%. That's just, you're walking in the door amount of dilution that you're looking at giving up. Plus, you're going to have ongoing rounds of funding. So it's important, I think, to determine how much dilution you're willing to actually accept in terms of deciding which path you're going to head down from a capital raise perspective. And I know we talked a lot about dilutive rounds of funding. The one piece we didn't talk about was convertible notes. And there is an opportunity for some of these companies to think strategically about, if I've got a runway that I know over the next 12 or 18 months I'm going to get a lot done in my company that's going to add a tremendous amount of value, maybe one of the alternatives is to think about a convertible note with a future priced around at some higher valuation that's going to help limit dilution at that point in time.
Okay. Rick, oh, go ahead.
Yeah, the one thing I'd add here, to go off in a slightly different tangent, is that when you decide that you want to start a biotech company, whether it's medtech or therapeutics or digital or whatever, you've got to recognize from the get-go that the the market that you're entering is a global market, and you've got to be cognizant not only of your global competition, but the capital for this market is global. And so I think I'm a longtime Philly guy, and I think one of the mistakes that companies have historically made in our region is that they've concentrated just on trying to raise capital locally, and that's to some degree limited their vision of the company and their and their capital base. You really have to compete in this global market. You have to get out there and beat the bushes, and that means finding the conferences where you can meet these investors, which are likely to be, somewhere else, whether it be Avitech in the Midwest, or Minneapolis, or Bio out in the West Coast, or even conferences over in Europe. And of course, a lot of them are being done virtually now, but you've got to broaden your vision. It's going to improve your chances of raising the capital that you need, as well as finding the right investors and the right partners to help you build a company that can compete in this global market.
Okay. Yeah, thank you all for the great answers on this question. So I know one of the most important ways to secure funding is to have a great pitch. So Rick, I'm going back to you on this one. What all goes into a great pitch?
Well, again, this is another one of those questions which is simple on the surface, but there's some complexity here. So for one thing, you should have a number of different pitches ready to go. People talk about the elevator pitch, where you can, within the course of 5 or 10 seconds in a single sentence, describe your company and why it stands out. So that I think that's really important, because you never know, as you're out there making the rounds of cocktail hours, when you'll stumble across somebody who might have an interest in your technology. But for a typical investor pitch that you're going to send in, there absolutely has to be something about the science and the particular sort of niche that you have, that you're better than anyone else. That has to be explained very succinctly. That can't be left as just a black box, or else people are very quickly going to not be interested, or not, because it's going to require extra effort for them to delve into it. You have to quickly explain, show that you have the right team, that the people who can be expected to succeed in this difficult environment, and you have to have a clear outline of the milestones that you expect to achieve with the funding that you're trying to raise. I think those are the really key things. Now, notice I didn't talk about market. I think a lot of people spend way too much time trying to explain a marketplace, when most of the investors that you go to will understand, knee osteoarthritis. Okay, that's a big market. Heart failure, that's a big market. Unless you're, in a very particular niche that people might not understand that there's a market opportunity or a medical need there. I don't think you have to go into huge depth in terms of market. But if you can cover those other things in a 15 slide set, then you stand a chance of at least getting your foot in the door.
Okay, thank you for that.
Can
Anurag,
can I
go
add
ahead.
one thing to that?
Yeah, go
Would
ahead.
you mind? The one thing we don't spend a lot of time talking about is the actual pitch itself, right? I mean, we spend a lot of time making the absolute best pitch deck, and we probably go through making 15 and 20 of them, and every single one of them is the next best pitch deck that we've got. I think the piece that people miss, entrepreneurs really, when they're talking to a venture firm, is that first meeting is not a meeting for you to get funded. That first meeting is a meeting for you to get a second meeting. And you can't walk into these meetings with this viewpoint that I've got to get every piece of my knowledge out on the table in the next 45 to 60 minutes. Your goal is to get people interested. And I think the comment about, your elevator pitch, we call it your value proposition. And I used to have a boss who told me that if you can't write it on the back of a business card, then you've got to rethink what you're doing. And so I think the goal for these meetings has to be to get to the next meeting and understand that these are going to be a series of meetings before you get funded or you find somebody who's going to give you the green light to move forward. And so you have to try to not feel like you have to fire hose people with information in your first couple of meetings. Give them enough to get interested, and also give them the runway to ask smart, intelligent questions of you that you are well prepared to answer. And I think that helps an awful lot in making these pitches successful.
So Mike, are there resources that you know or you used to help you create these pitch decks and create your pitches?
Yeah, there's all kinds of resources that are out there. I mean, even some venture firms themselves will give you sample pitch books for guidance. And there's a number of the big venture firms in Silicon Valley that'll do that. You can get help from the National Venture Capital Association of America website, not just in terms of help with that, but also help with term sheets. So there's multiple resources out there. I think the key is to make sure you're solving a big problem and that you've got a great solution to solve that problem. And but there's you can go on the web and you can find multiple samples of pitch decks. But I think keeping it simple, keeping it short is another important thing. I mean, you don't want to walk into a pitch with a 40-page pitch deck. I mean, typically I've seen them more successful being in the 15 to 20 page range.
Okay, thank you for that. Anurag, I'm going to ask you, so during these pitches, what are some common questions that VCs like to ask, and what are some questions that have only come up during the last couple of years?
Yeah, I mean, like there's some, standard. There'll be obviously, if we are a life science venture fund, there'll be a lot of questions on the underlying science. I think that is that's where at least our fund spends most of the time initially. And again, the questions depends on what's not included in the deck, right? So if I'm assuming things like financials, what are you going to use the money for? Those are included in a pitch. But the science is always where there's a discussion. And the second place where there's a big discussion is the development, and is the funding will get them to the right inflection point. And that inflection point sometimes is differently viewed from the company versus the investors. And it is very critical to make sure that, we always ask the question, I'm ready to raise. A more difficult question is to answer, how much should I raise? It's always easier to raise later with better data, right? It's not always right to raise less because of less dilution. So I think, there's a lot of discussion around that. Because one thing that everybody should keep in mind is, before the investment, investors in the company can almost say we are pulling in the opposite direction. But once it's invested, what they both want is that money is going to get them to a big inflection point so that they can make the best use of that money. So it should be the prime goal of a company to align with that on the investors and make sure once the deal is taken, it's going to the right direction.
Okay, and are there some questions that have only come up during the recent years because of the pandemic, because of the market that you guys are looking at?
I don't think so. I mean, for us, what it has accelerated is the question that has come up is, because the capital was available, what more can you do? Like, if you had additional resources, could your platform be further expanded? Could you prepare faster to, access public markets, right? I mean, there were certain events that you did at risk. So those questions came up. But I think from the drug development point of view, I mean, outside the company that focus on pandemic-related resources or opportunities, the rest of the drug development remained the same. There were more questions around executing clinical trials. Like now, we are asking the questions around some of the Eastern European recruitment that's heavily used in, some of the autoimmune disorders, and therefore being able to not do that changes your execution plan. So there are certain changes that are, obviously inherent to the markets going on, but on a broader scale, the therapeutics, it's been the same. The drug development hasn't been affected.
Okay, thank you. So we have about 18 minutes left. I'd like to open this time up for any questions from the audience. We have some prepared, but just so that it's more of an interactive, please put some questions on there. I'd be happy to ask them to the panelists. So I guess going back to the pitches and while you're lining up deal searches, are there certain things that, this is going to Mike, are there certain things that from the biotech side that you're doing to de-risk your business model while you're lining up these investments?
I mean, that's always front of mind, and that's part of the whole value creation piece of this is, at different stages of funding, what have you done to really de-risk your business model? And for us on the medtech side, those are things like, in the early stages, you've got innovation risk. Can you actually take something that somebody wrote on a napkin and reduce it to practice? What's the engineering that goes into that? Then you run into product development risk, intellectual property prosecution risk. And what some people forget is that it's not just about getting a patent on your technology, but even longer term, do you really have freedom to operate? And at some point, you have to think about getting freedom to operate opinion around your intellectual property portfolio. Then you've got the standard regulatory risks, clinical risks in your business. Importantly is reimbursement risk. Does reimbursement exist for your particular product category? Or do you have to go to CMS and do you have to figure out a way to create that? And then in the later stage is commercialization risk. And so you sort of take each of those in order and start working at de-risking your business. I think it helps from a capital raise perspective, and it certainly helps from a value creation perspective as you get closer and closer to potentially attracting a strategic acquirer for your business. I mean, we talk an awful lot about all these companies going public, and we talked earlier about the IPO market, but the reality is the entire venture-backed market, the vast majority of exits has really been strategic exits. And we think of an IPO as an exit, but the reality is it's a valuation event for all intents and purposes. So de-risking the business and hitting each one of those segments head on in a particular order, I think is a really important part of the whole value creation chain.
Great, thank you for that. Rick and Anurag, do you have anything to add?
Nothing more from me. No, as I said, the investment is really when you look at what investors are doing, they're essentially using the money given to them by their limited partners to invest in something so that's worth more in the long term. So it's a matter of how is it worth more? Well, one thing is you've progressed the science, you've achieved some milestones. The other thing is you've taken risk out of the product and its likelihood to succeed in the future. So if you can envision your work and your plan as those two things, then you and your investors will be aligned.
Okay, thank you. So we have a audience question. I'll pass this over to you, Anurag. What do you foresee in the area of funding for digital diagnostics, such as imaging, clinical labs, mobile devices utilizing AI database analyses?
Yeah, I mean, look, this is the one part of, the healthcare system that has seen a significant change. Telehealth has really, been had made a broad impact on technology across healthcare, whether it's drug development, healthcare services. It's all getting a lot of attention. However, this piece of diagnostics being moved into automated, I mean, that has been a system that's going on for a while. I think there is some structural challenges with how things are done that makes it challenging, and then there are sometimes the incentive alignments across the value chains are not aligned, and therefore it causes some friction. We have not seen venture like billion-dollar companies come out in that space. They can be great businesses that have worked at a smaller scale, but we haven't seen a lot from venture activity in it. Now, when your data collection becomes very large, then there is some more of, let's say, the technology focused investors are starting to look at that and look at a broader applications of it. So that is a shift that we are seeing with the technology sector and healthcare sector coming together, but more of a, let's say the older AI versions where, you were looking at chest x-rays and stuff. They haven't gone up to get enough traction in the market.
Okay. Mike, do you have anything to add to that from the medtech side? Oh, you need to unmute.
I'm a medtech entrepreneur, not a technology entrepreneur. That's the problem with the mute. I think there was a point that was made earlier that I don't want us to kind of lose sight of, that I think is an important part of this also, is the whole idea of capital efficiency. And the piece of that I think is important is, I mentioned earlier, 90% of all startups fail. The number one reason why many of them fail is lack of funding. And so being capital efficient as part of de-risking your business model, I think, is also important. And one of the things that we've done in terms of being able to do that is not building a huge team from day one, outsourcing a lot of our critical needs for our business. We've outsourced clinical, we've outsourced regulatory, we've outsourced some of our engineering, we've outsourced manufacturing, some of our product development. And it's allowed us to really kind of get to market quicker and on a smaller budget. I mean, the typical medtech company, I think, is a sort of a 4 to 7 year window to get your first FDA cleared device, maybe a budget of 20 to as much as $70 million. We've been able to achieve 7 FDA cleared devices in less than 3 years on a budget of less than 10 million. And a lot of it is tied to the capital efficiency piece. And we talk about taking risk out of the business. And a lot of that kind of comes into play as well as it relates to that.
Okay, thank you. So there's another audience question that kind of touched on what you discussed earlier, Mike, about the convertible notes. So when considering a convertible note, is there anything a company should be aware of versus a traditional investment?
Well, what you don't want to end up with is a, this is sort of viewed as bridge financing. You don't want to bridge to no place, right? You need to make sure that that's going to ultimately get converted into some priced round of funding or equity at some point in the future. So being focused on all of the back end terms in terms of what does it take within your term sheet to get to a priced round of funding? Are you setting a certain hurdle rate in terms of a minimum dollar amount to be raised? Certainly, also making sure that you have the ability to negotiate a proper cap on the valuation. A lot of times these convertible notes will convert at some discount to the next priced round of funding. We've seen as much as a 20% discount. If there's lower risk in the business model, you can see something slightly less than that. But the other piece is what's the cap on the overall valuation, and what is it that you think that you're going to achieve in that 12 or 18 month runway that's going to add incremental value to your business? Because the last thing you want to do is have a 20% discount on the next priced round, but you have a cap in there of a $10 million pre-money valuation, and all of a sudden you're getting a round done at 50 million. Well, you've kind of lost the benefit of having a convertible note in place. And those are pretty simple transactions to get in place. Again, a great resource for finding term sheets for stuff like that is the National Venture Capital Association of America website. There's great explanations of what all of the individual terms mean in those types of term sheets. And then there's also PIPEs as well, which is more of an equity type of transaction that people can think about in that regard.
Okay, thank you for that answer. Another one from the audience. I'll throw this to you, Rick. In addition to a pitch deck, are there other materials or information that a company should have readily available for the potential investor? And what else would they ask for in follow-up discussions?
Yeah, so one thing that we find really useful is frequently the founding scientists have published on their science. Obviously, maybe not disclose the particular molecule that's being developed or something, but published on the pathway and the target, maybe using some tool compounds. So we like to see publications when they're available. If you have patent applications or granted patents, and they've been published, those are useful to share with people. So those are some key things that we look for. Just in general, I think it's good to anticipate in the long term that, if somebody's interested, they're going to want to see everything. And that means even your confidential information, whatever that is, patent applications or confidential information um, about your data, et cetera, contracts that you have with academic institutions and so on. So it's a really good idea from day one to make sure that you organize your records in a way that they can be easily accessed, and shared in something like a data room, or at least you know where to look to find the things, and so you can provide them expeditiously upon request. A lot of early companies, record keeping and organization is a secondary thought to them, and it's not always easy for them to track these things down or to set up a data room, say, once a CDA is signed and diligence is underway. So it's a good idea to keep that in mind from day one.
Okay, and Mike, you said earlier that the first interview is to get the second interview. So what goes on in the second interview, and how can you prepare for that?
Well, I think you get more in depth into the process, and I think the benefit you have in the second meeting or the second interview is you've already established a dialogue with the firm, and so you can actually spend a little bit more time up front before you even get there to get a sense of what the agenda needs to be for that meeting, and understand specifically what the VC firms want to see and hear from you. And I think it just gets into a deeper dive of all of the different pieces that we've talked about during the course of this program earlier today.
All right, thank you for that. So we have about 5 minutes left. I'd like to take this time and let the panelists, if you guys have any concluding thoughts, I'll go over to you, Anurag, first.
I think for the community, this market is tough. Raising is tough. Being patient is the key, and capital efficiency is the word that everybody is going to talk about now. And so, the more you can do with your money you have is the mantra for next 6 months of least, it feels.
Okay, great. Rick, do you have anything?
Yeah, I would just say that, yes, the market is tough, but there's still a lot of money out there that's going to have to be deployed. Raising money has never been easy. It takes work. Like I said before, you have to be willing to go where the money is and chase it down. You can't just expect that you'll find it in your backyard. And remember, it's not good science that gets funded, it's good businesses that get funded. You have to be able to show how your good science is going to translate into a business. So if you can, you're willing to go look for it, and you have the right story about how you're going to, end up with a really groundbreaking business, I think you'll be in good shape. The last thing I'll say is don't forget about the non-dilutive side. A lot of times people, when they make a commitment to raise equity, they decide they're going to leave behind SBIRs, STTRs, all those things. I know it takes time. I know it's a hassle to go through the application process. But the approval rate for those things is usually many times higher than the approval rate at any particular VC. So a VC might invest in 0.5% or 1% of what they see, whereas an SBIR approval rate, might be 10 or 15%. So don't forget about those other avenues as well.
Okay, thank you. Mike, do you have anything?
Yeah, I mean, these are great anecdotes from everybody. I echo the whole non-dilutive funding piece. We've been very successful at raising capital for our clinical work from the National Institute of Health. Many states, depending on where you are, actually have match funding programs for SBIR funding coming out of NIH. And so that's important to look at. Don't forget about your local states either. I mean, we've been successful at raising meaningful amounts of non-dilutive grant capital from the state of Pennsylvania. We've gotten 2 separate grants for $1 million each. They've provided us with match funding grants to help expand manufacturing as well. So those are important pieces. And the last thing I'd like to touch on, something that Rick mentioned earlier, and as we kind of get towards the end of the diligence process with a VC firm, and they start thinking about the whole data room piece of it, you need to be really thoughtful about how you actually organize your data room and make sure that you make it as easy as possible for that firm to do their due diligence. Because if you don't make it easy, you're going to go from confirmatory diligence to some type of proctology exam that you're not going to want to have. And the comment I'll make in that regard is, for us in the medtech space, we're constantly doing internal audits on ourselves. And we're getting third-party entities to come in and do those audits, whether it's a mock FDA audit, whether it's a QA audit, whatever the case might be. And invariably, people are finding little things that we need to do a little bit better, and that's the reason to do those audits. Part of this is don't do an audit, have all these issues listed, and then make it difficult in your data room for people to find out what it was that you did to correct all of those issues. So it's making sure you're thoughtful about how you're putting things into folders in the data room, that it can be followed very easily, that it's very intuitive for anybody who doesn't understand your business in the way that you do, can go in and do that diligence and find everything very easily. And I think that makes the whole diligence process go a lot smoother and benefits you in the long run.
Okay. Thank you for that great concluding remark. I'd like to take this time to thank the panelists. Thank you all for the great insights today. And also thank you all, the audience, for joining us today. Erica, I'll pass it back to you.
All right, thanks, Brian. And for the audience, please note that this session was recorded and will be posted to our BioStrategy YouTube page shortly. So if you want to revisit any of the segments today. So thank you for joining the Practical Knowledge Series, and have a great afternoon.